Good morning. Congratulations for all of you who have managed to deal with the woes of this weather and with Continental Airlines. My name is Dick Cavanaugh, and I'm the Acting Director of the Center for Business and Government and also the Executive Dean of the Kennedy School. And I'm delighted to welcome you all here for what I think is going to be both an important as well as an entertaining day on a very important issue. The Center for Business and Government is one part of the Kennedy School, which is in part one part of Harvard. And we are the part that tries to figure out how business and government not only coexist in market economies, but try to work together better. The person who is going to be presiding at today's activities is known to most everyone in this room, but nonetheless, I will introduce him. His name is Robert Glauber. He is sitting to my left. Professor Glauber, despite having received a number of degrees from Harvard, has gone on to be a success. He was a professor at the Harvard Business School. Indeed, one of the things that he has to live down is that Professor Glauber was my finance professor, which I know now what's going through your minds, which is that either I'm an awful lot younger than I look, or he's an awful lot older than he looks. Professor Glauber then was the executive director of the Brady Commission, and then became the undersecretary of the Treasury, and now has returned to Harvard, where we have the good fortune of him serving as a fellow in the Business and Government Center here, as well as a member of our faculty. So with that, I will turn this over to Bob.
Thank you, Richard, and welcome. Thank you all for coming. I think now that 5 years are past, it's probably safe to go back and open the door and see what's happened. It's probably a good time for us to review what we've learned from the experience 5 years ago and what it tells us about some of the problems that we will face in the future. We have a panel this morning which is two-thirds here, and I suspect by the time we get into the morning, people from Chicago, the other people from Chicago, excuse me, will have made it as well. In the 5 years since the market crash, the exchanges, the regulators, Bush administration, Congress, I think have made great progress in structuring the markets for stocks and stock index futures. I think today the chances are remote that the markets will experience the kind of rapid, violent, chaotic decline that they did back in 1987. The reason is that the internal market mechanisms themselves will not become the force which drives the markets down, as those mechanisms did back in 1987. In 1987, minor events triggered a major market disruption, a violent episode, when the markets essentially ceased to function correctly. Pricing relationships between stocks and futures broke down. Markets, in particular instruments, experienced difficulties in staying open. Serious supply-demand imbalances developed, and very large market moves occurred in the absence of underlying fundamental information. When you recall that the market started out on October 19th with the Dow at 2247, traded as low as 1400 on the Merck by noon the next day, October 20th, and then closed at 1841 that day, it's clear that more than just fundamental forces were driving the market. Major market disruptions like this happened 4 times in the last half of the 80s, October 19th, 87, October 26th, 87, January 8th, 1988, and October 13th, 1989. By contrast, such moves had occurred only 3 times in the 45 years between 1940 and 1985, twice in May 1940 and once in September 1955. And each one corresponded to a definable event. In 1940, Dunkirk, and in 1955, President Eisenhower's heart attack. The violent disruptions of the late 80s were not days of excessive price fluctuations or increased volatility. They really were something fundamentally different. A dramatic evaporation of the market's liquidity, a near shredding of the fabric of market coherence. And the cause was very simply the market's internal mechanisms. Rather than transmitting fundamental forces, the mechanisms themselves became the force which contributed to the violent declines. The mechanisms became the message as well as the messenger. From this analysis, the Brady Commission made 5 proposals to prevent the market's own mechanisms from getting in the way of the markets. These proposals all arose from one basic observation, that the markets for stocks, stock options, and stock index futures are in fact one market, connected by technology, by institutions, and by trading strategies. Regulation must both reflect and protect the coherence of the one market. The Brady Commission viewed its proposals as really rather modest regulatory enhancements, more than justified by the chaos and near catastrophe of the 1987 crash. Many very much disagreed with us. They felt that the proposals were too intrusive, that they went much too far. And almost all the wise handicappers inside the Beltway pronounced these proposals politically dead on arrival. Today, all of these proposals have been implemented, either by voluntary industry action or by congressional legislation, which of course couldn't have happened without industry support. Let me just very quickly review those 5 proposals on the Brady Commission list. First, circuit breaker mechanisms coordinated between stocks and stock index futures. The idea is to give the markets pre-planned, fixed timeouts so that participants can catch their breath, assess the situation, and as needed come up with additional funds. What's important is that the timeouts be pre-planned, part of the institutional landscape, so that when they're triggered, nobody is surprised. Circuit breakers have been instituted voluntarily by the exchanges in one of the healthiest examples of self-regulation. And circuit breakers have worked, most recently on the dramatic whipsaw day last October. Market participants, once skeptical, have become supporters. High official of the New York Stock Exchange was quoted recently as saying, "I was a skeptic for years about circuit breakers, and I didn't think they would work in a time of crisis. I was wrong." The second proposal was federal regulatory oversight of stock index futures margins to assure that they are set consistently with stock margins. Brady Commission argued that futures margin levels affect not just the futures markets, but the whole market system and indeed the whole financial system. It's unfair and unreasonable to expect the futures exchanges to make the margin decision on their own in a way which protects the whole market system. Federal regulatory oversight is needed. In recent months, the futures industry has joined the Treasury Department in supporting federal oversight, which has been made law by Congress in the CFTC reauthorization bill, which was just passed at the end of the last session. Third proposal was one agency to coordinate the critical intermarket regulatory issues, which really, when you get down to it, are primarily margin levels. Same CFTC reauthorization bill gave the Federal Reserve Board overall responsibility for stock index futures margins, matching its already legislated responsibility for stock and stock options margins, and allowing the needed coordination. Just as the Fed delegates margin authority for stock options to the SEC, it's mandated to delegate stock index futures margins to the CFTC. Fourth on the list was intensified efforts to unify clearance and settlement systems. 1990 SEC Market Reform Bill directs the SEC and the CFTC to cooperate in this effort. And some progress has been made, particularly cross-margining between stock options and stock index futures. But here, I think a great deal more needs to be done, and I suspect some of our panelists will talk about that. And finally, fifth, enhanced information disclosure for large stock traders, bringing disclosure for stock trading up to the level already in place for stock index futures. This, too, was mandated in the 1990 SEC Market Reform Bill. In addition to these changes, the exchanges themselves have substantially increased capacity and clarified trading rules. And the regulators have opened communications lines to assure coordination in times of crisis. The effect of all of these changes is markets which almost all commentators view as less susceptible to the violent, chaotic sell-offs which occurred in the past. Certainly markets will go down if they want to, but they are less likely to overreact, plunging violently one day only to snap back the next. Treasury Department and the regulators have provided leadership, and Congress has played an important and positive role with the legislation it's passed. This legislation has happened in large part because the private interests affected, largely represented by the people in this room, have, after considerable discussion and bargaining, agreed on changes acceptable to them all. With that as introduction, let me just introduce the format for today. This morning we're going to have a panel of regulators, exchange officials, who essentially were on duty back in 1987 when all this happened. And what they're going to discuss with you is both what happened and what went wrong then and what's been done since then to deal with it. The format I think I'd like to use is this. We have, or will have, I hope, if the planes land, 6 members this morning. Rather than have all of them speak, maybe what we'll do after each one is take a few questions relevant to that particular set of comments. And then at the end, we should have ample time for the panelists to discuss and for you to discuss with the panelists, all of the panelists, anything you want. When we get around to questions, let me remind you, since we are being taped, if you'll come to one of the microphones, then the people can hear you as well as see you. Finally, the order, I've taken the chicken's way out on this. We'll do it alphabetically, which means that we can start with Duke Chapman, who, as I'm sure all of you know, is chairman and CEO of the Chicago Board Options Exchange. Duke was CEO of Shears and Hamel back when it was Shears and Hamel, and eventually, as it changed itself, eventually was co-chairman of Shears and American Express, moved on to the American Express Bank in London in 1982 as vice chairman, and then to the CBOE in 1986. I think that those of you who remember what happened back in 1987, the CBOE was one of the institutions at the front line of all of this, so it's good to have Duke to lead off. Duke?
Good morning, and Bob, thank you for giving me the opportunity to participate in this panel. I suppose it's probably might be considered uncharitable to pick a bone or two with the introduction of a topic by our host, Mr. Glauber, but I suspect there's some people in this room, and maybe even a few up here at the head table, would think that the markets weren't the messenger and the message. The market mechanisms were put under tremendous stress back in '87, and there has been significant change made since then. But if one would stop and think that the Dow has been depicted by Bob during the previous week before the 508-point drop on Monday the 19th, the Dow had already experienced its first 100-point day in history on the previous Friday. The Dow had already been down another 100 points plus in the preceding week. And certainly in the early part of the morning, as the sell orders came in over the weekend, it wasn't market mechanisms that had decided over the weekend that the securities holders of America and the rest of the world were going to start selling on that day. And somewhere in that day, maybe mechanisms started to get stressed, but we clearly must have moved half of the total move of the 2 weeks before the stress really became the kind of thing where you might look to the market mechanisms. Having said that, I'll get back to the subject at hand, Bob, and maybe start with what went wrong. And I think, investors reevaluated the risk-reward of owning equities at the lofty valuations reached after 5 years of a vibrant bull market, rising from the low of Dow 800 and change in August of 1982 when the market started up until it faltered early in the 6th year of that market rise. Price-earnings ratios were at record levels, and the Dow had risen over 300% during that period of time. It was clear that looking back, the speculative bubble was about to be pricked in an unprecedented way when, after that first 100-point day in the history of our markets on Friday, October 16th, investors spent a weekend reviewing their portfolios. Their decisions obviously were to sell, and many of those who couldn't make up their minds did so as they joined the selling waves that sent the market down 508 points on that day, Monday, October 19th, with, if I remember correctly, over 600 million shares trading on the New York Stock Exchange. In 2 days, 25% of the value of corporate America, as measured by the Dow, had disappeared, evaporated. It was an unprecedented day in the history of markets, an unprecedented day certainly in the history of our markets. I think the unreported major news of the day, and I guess I'll say this in the middle of what went wrong, was that the markets worked. No one bothered to think about the fact that the markets work. If you'd gathered a group of us, it didn't have to be me necessarily, but a group of you who had spent your lives in the marketplace, who understood our markets and their capabilities and what they'd handled, and you'd sat down a week before on, let's say, the 12th of October, and in a classroom here decided, let's play break the market, and tried to figure out at what levels of volume and what kinds of price movements the market mechanisms might not work, might not be able to transmit the shock of changing valuation through the marketplace from buyers to seller. I don't think we would have come up with 508 points in 1 day and 600 million shares in the underlying market and the various echoes that went through all the other markets. We probably would have stopped somewhere short of that. It would have been more than 200 million shares. It would have been more than 200 points. It might have been 400 points. It might have been 400 million shares. But I think that was the other piece of news out that came out of that market break. As we went through this incredible period, Monday actually was a day that kept grinding ahead and grinding down, and as Bob said, we now have circuit breakers, and given what's in place, we would have stopped for an hour's breather after 250 points on the Dow, and we would have stopped for a 2-hour breather after 400 points down on the Dow, and that might well have been the end of the day. But we didn't stop, and the market kept on going, and business was transacted. The market didn't close, and I think the performance in light of what was happening was impressive. Overnight, on Monday night and Tuesday morning, the trades had to be matched. Cash had to be assembled for Tuesday's settlements in the derivative markets and margin calls throughout all of the markets. And as most parties ran for the high ground of cash, stresses started to appear in the system. Stock loans were called. Everyone wanted their cash back, and they wanted it back in a hurry. They had to be repaid on demand. And once again, however, with encouragement from our regulators, from the Federal Reserve Board, the banking system responded. The loans were made overnight at unprecedented levels of authority. Loan officers calling from home to call their bosses to say, here's what I'm about to do, tell me if I can't. And the system did stay liquid, and the markets were ready to open up again on Tuesday morning. On Tuesday, as the market whipsawed up over 190 points and back down over 200 points, in our market we were faced with unusual problems. Volatility had soared to unprecedented levels based on Friday's price movements and on Mondays. And new option series all of a sudden had to be listed. We listed 1,700 new separate options series on that morning. Many of them had, as a result of the 500-point move, 8-point move the day before. Many of them, right up here, gentlemen. Many of those series had never traded before. They had never traded the previous day. They had to be added overnight because of the price changes. From its inception 20 years ago, the CBOE has operated under the policy that single price openings are the fairest way to start the day's trading. We and our regulator had felt that trying to come to one price opening for everyone in the marketplace made sense. And we had a systems of opening rotations in which we would take each of the series and we would open them, matching off buy and sell orders, and then going to the market maker crowd to trade the balance and define a price at which everyone could open at the same price and move on to the next series. Now, this was a procedure that usually took, on a busy day, maybe 15 minutes, sometimes less. In the same meantime, while that was going on, in our indexes, the New York Stock Exchange would be opening their various stocks and underlying stocks. And this morning we were faced with 1,700 new series, in addition to having to open all of those that existed already. And while that opening was going on, the underlying cash market went up 190 points and went back down again, creating incredible volatilities on top of incredible volatilities. And the end result of that for the CBOE was that we remained in rotation for well over 2 hours into the afternoon before we ultimately went to free trading. That kind of stress is what I think Bob said, was that on the next day there were additional stresses interjected into other markets and into our market. Customers got their business done, but it was in this rotation process. Those who traded all traded at the same price in a rotation process. I'm sure other commentators, and particularly our new arrivals from my hometown of Chicago, will add their perceptions, and volumes have been written and more will be written about what happened in 1987. And in the short time allowed to me, I thought maybe I told Bob I'd just as soon focus on what has changed, what is different, and maybe what implications does that have for our marketplace. Prior to, I think one thing that's clearly changed, and that's the market participants' perceptions. The traders, the investors, the portfolio managers, the speculators in the marketplace all entered October of '87 with a morning perception as they started the day doing business of 1929 happened 58 years ago and it won't happen again. That was the perception that most people approached their business day with as they came into that week that was back in 1987. And now, as they finish their coffee and turn to the trading desk or look at their PC to look at their portfolios to be making decisions, they start with a different perception. And as they start out the day, their mindset is 1987 happened and it can happen again. And that is, I think, one of the things that makes the markets different today than they were 5 years ago. That all of the market participants are aware that we could have this kind of day again. And secondly, I won't spend a lot of time on circuit breakers. Bob has talked about the circuit breakers. They were recommended in the report. All of the national equity markets will halt, as I said, for 1 hour when the Dow is down 250 points, and 2 hours when it's down 400 points. And long before those halts have been triggered, the NYSE will disengage program trading, activate the Private Investor Express. I think that's what it's called, Dick. Rule 80A will have kicked in, and program trading will become disengaged. And in Chicago, across the way, the Mercantile Exchange will have triggered its trading limits, 5, 12, and 20-point trading limits, which I'm sure you'll hear about from them. The market decline will have been slowed down, and investors will have had a chance to collect themselves, make new decisions during the halts, think about in a little more leisurely way than they did on the 19th and the 20th and the 16th of October 1987 about what they're going to do. Now, maybe the message will be the investors and not the mechanism, and they'll all decide to keep trading, but they'll have had a chance to think about it and gather their thoughts. And as Bob said, People will be assembling money. Intraday margin calls will have gone out. People will have chance to do things that need to be done. And I think it's been a constructive change. There still are critics, some in our universities in Chicago, of trading halls. Portfolio insurance would be the next thing I'd talk about. Institutional investors who thought they'd insured the values of, everyone has a different number, 60, 70, 80, 90 billion dollars worth of equity portfolio values using the futures markets, discovered that they became dynamic hedgers, caught up in the crash like everyone else back in 1987. The drop was so dramatic that to adjust their market exposure, they had to enter the market. At the time of the crash, institutions did not use the options market to buy insurance, and for several reasons. First, futures were cheaper. There's no need to pay for a time premium if you could enter the futures market and get the job done. Second, position limits were low. The SEC had just agreed with the CBOE back in September of 1987 to double the position limits from 12,500 contracts to 25,000 contracts, and prior to that time, it wasn't worth it, as the institutions looked at it, to get into options. They couldn't get big enough market exposure. And as their portfolios had grown so dramatically, the institutionalization of savings in the market, it wasn't worthwhile. Today, position limits have been increased significantly and dramatically for hedgers. The S&P 500 options contract has 1.5 million contracts of open interest as of this morning. It trades on average 60,000 contracts a day. These contracts are $43,000 contracts at today's market levels. And with many days, like yesterday's 110,000 contracts. Much of this activity is the insuring of portfolios by institutions. Come the next event, when and if it comes, those portfolio values will be protected and won't add to the selling pressure. A significant, and those portfolio managers can sit in the sideline or they can join the fray, but their portfolio values will be protected because they pay the time premium. Much of this activity is now taking place in an environment where it's very hard for us to read what will happen. We've had a significant growth of the over-the-counter market in equity indexes. No one's quite sure how big that market is. No one's quite sure how hedged that market is. They are very sophisticated market professionals. I wouldn't jump to any conclusions, but there is some concern that in an event, those unhedged, if they are unhedged tails of risk, will become dynamic hedging the next time around. Fourth, cross-margining. In 1987, as markets declined, intermarket positions that were economic equivalents, futures and stock portfolios and options, and as they declined, the futures and the stock portfolios, it required cash margin as soon as possible. The offsetting options positions increasing in cash value, the puts going up as the market went down, the cash was not released. And there was no cross-margining mechanism to provide for offsets so that the cash increase and the increasing puts can offset the margin calls for cash coming from the other markets as those securities declined. Today, with the cooperation of our regulators and the Chicago Mercantile Exchange, the SEC, the CFTC, we have now implemented cross-margining at the clearing firm level between the options exchange and the futures index market, and currently well on the way to doing it for market makers who are not clearing market makers. And when that's implemented, we'll have made two major steps, which will be protective measures for our future event. And I guess almost a companion piece, but really different, is there's been tremendous strides made working with the SEC to move towards a risk-based capital system, a risk-based haircut system in our business. And instead of going on our traditional capital haircutting system, we have now been running in a pilot mode for the better part of a year, measuring all of our firms and all of their accounts and saying, What if the market goes down 5% or up 5 or down 10 or up 10 or down 15 even or up 15? What would have happened using the two different kinds of systems? And a risk-based system would put very heavy penalties on people who had naked short position, had naked positions in the market, who were greatly exposed, and in many cases back in '87, didn't have the cash to meet their obligations, putting tremendous stress on the system. Customer margins were increased twice after the '87 market break in the options markets. They remain at that high same level today. There have been no real push to lower them. They're high enough, given current volatilities, to cover 99.9% of the moves looking back over the last year, probably, or maybe some wits in our organization say 110% of the moves. They're at a very high level relative to volatility, and they're sitting there, and I don't see any pressures to change it. And finally, customers who want to engage in uncovered strategies, the people who are selling out of the market teeny puts back as the market was rising, taking their premiums and going out and spending them, or doubling down and buying more teeny puts and getting more premiums, now have to jump a lot of hurdles if they want to do that. It has to be a reasonably sophisticated investor. That investor at some firms has to have $100,000 cash in the account. I don't know of anyone that has less than $50,000 requirement. That investor has to have that strategy approved by a senior compliance officer within the firm, specifically to do those strategies. And I think the market is much better positioned now, because of these reasons, to handle another event when and if it happens. Thank you all very much.
Any of you have a question or two specifically for Mr. Chapman? Otherwise, we can do them at the end and address them to everybody. Okay, fine. Why don't we then go on? Next speaker is Tom Donovan, who, as all of you know, is president and CEO of the Chicago Board of Trade, the largest futures exchange in the world. Before coming to the CBOT as its secretary in 1982, I'm sorry, 1979, Tom was an administrative assistant to Mayor Daley, I guess the former Mayor Daley. At the CBOT, he became president and CEO in 1982. As you know, the CBOT traded one of the two major futures in contracts back in 1987, the MMI. Tom, good to have you.
Thank you very much, Bob. First, let me apologize for being late. Believe me, I left on time. I left my house at 4:45 this morning for a 6 o'clock flight, and Bill Brodsky and Leo Malamed were on the flight, and I also apologize for the weather in United Airlines. I normally try to be on time, but and I'm sorry, Bob, that I missed your opening remarks. First, let me congratulate you on putting this group together today. I really don't know of any other person or any other occasion that could have brought us together, because there are so many times that we work together as the exchanges, the Board of Trade, the Mercantile Exchange, and the Options Exchange, that we can't even resolve our schedules. And to get this today and to have the members of this panel and the panel that you have this afternoon is just tremendous, and it's a real tribute to you. Listening to Duke and hearing him allude to your opening remarks, I can see that there's going to be quite a bit of overlap today on the part of all the speakers, because most of us will see similar causes and virtually all the solutions are the same. So what I'll try and do is not cover some of the same things that I would have, that I know Duke has already gone into, and talk from a little bit different perspective. Every one of us know where we were on October, in that fateful day. I don't know if anyone was in the situation that I was at that time, because I wasn't in Chicago, and neither were any of the leaders at the Chicago Board of Trade. We were in New York. For the first time in 5 years, we had scheduled a board meeting in New York to meet with the member firms and to be visiting with them to talk about what was happening in the markets for our members to see their trading rooms, to get a different perspective. So as we landed and got to the offices, and I happened to be in Goldman Sachs, you can imagine the turmoil. I mean, we were just in everyone's way. And for those people that took the time with us that day, I have a great deal of admiration, because they were watching the world crumble around them as they were trying to be good hosts. Just so happened, as an aside, that the day of the mini crash, I also happened to be at Goldman Sachs' office in New York. Now I've got two orders: either I don't come back again, or I let them know when I'm coming. So, but if you can imagine, as we were there, all we're saying is we wish we were back home. So the first thing we did was put some members of our executive committee on a plane and send them back, and immediately try and make arrangements to get all of us back that night, because we were scheduled to have a board meeting in New York, to have a dinner that night, and come back the next morning. So we were frantically trying to charter a plane and do anything we could to get back. Ultimately, what we were able to do was get our board of directors flights and on a plane leaving around 9 o'clock that night to get back into Chicago. Fortunately, to be in our offices at 5:30 in the morning the next day to make sure that we could do the best that we possibly could. And quite frankly, we lived on the phone all day when we were in New York. And not only with our offices back at the Chicago Board of Trade, but with the Board of Trade Clearing Corporation and with the White House. It was calls from Howard Baker, Beryl Sprinkle, urging us to do one thing: keep our markets open. And I think it's a tribute to these exchanges, faced with a tremendous crisis that they faced that day, to be able to do what they did. For the New York Stock Exchange, I mean, what their specialists must have felt must have been that the whole city of New York just fell right on their shoulders that day. And I think we can all talk about the causes, but I'd like to talk a little bit about what I think the results of this event, and I'll try not to touch on some of the things that Duke did. I'll talk from a little different perspective. I really didn't know Dick Grasso prior to that day, but we've had many, many conversations since then. I didn't know David Reuter prior to that day. We've had many conversations since then. I didn't know Bob Glauber. I knew Duke Chapman, I knew the Mercantile Exchange leadership, but we've all come a long way. But it's been a tough journey. First of all, when you had the day of the crash, it wasn't over on the 19th. The 20th was a very fateful day. I'd like to talk a little bit about that, because I think that's where the Board of Trade comes into play. And then the time afterward wasn't always the best of times for the people at this panel. There was a lot of acrimony. There was a lot of name-calling, a lot of blame-laying, a lot of defensiveness, and I think all of the people that were engaged in it on both sides actually felt that they were right. In hindsight, we might find that if we could look at it a little more objectively, we wouldn't have had that problem. But, 5 years later, after 28 congressional hearings, and myself spending over 100 days in Washington fighting legislation, from October 19th of 1987 to October 22nd of 1988, when the Congress went out of session, we had a great deal of work. Now, fortunately, from our perspective, Congress didn't legislate. I think they put our feet to the fire. They had enough hearings. They made us do the things that we should be doing, and Duke enumerated them. We did not have circuit breakers. Circuit breakers, it's a new term, but it's not much different from what we've done in futures for years. We've had price limits and trading halts, and that's what a circuit breaker is. We didn't have that because the users of the stock index contracts didn't want it. Hindsight says if we would have put what was successful in the futures industry in place ahead of time, they would have been there. We we talk about margins. I wish that we didn't call margins in the futures industry. I wish we would have been calling them performance bonds. We would have had a whole different approach and a lot more questions in Washington, but it forced us to do a lot of educating. And the result, I think, of the last 5 years is that people learned a lot. We all learned a great deal about someone else's business. And quite frankly, we all should have known more about it in October of 1987. But we operated as though we were all on our own. Board of Trade didn't coordinate anything with the Mercantile Exchange. We competed with the Mercantile Exchange. We certainly weren't dealing with the New York Stock Exchange, and we weren't dealing with the Options Exchange. And I think that was one of our major problems. And the CFTC wasn't working with the SEC on it. Certainly Treasury and the Fed weren't involved. But today, what do we have? We've got a system in place that has total coordination. Something can happen again, but I think that the mechanisms are in place to deal with it. The hotlines are there. The futures industry and the securities industry certainly have adopted a lot of similar practices. We raised our margins. We didn't like doing it. We always priced our margins on volatility. It was a major battle at the Chicago Board of Trade to make the decision to raise the margins and to what is termed a prudential level. Quite frankly, it was a very political decision. I think it was the decision that allowed us to be successful in Washington. We didn't raise them to 25%, which was the call. We raised them to approximately 15%. But it allowed us to give the people that believed that our markets in Washington the tools to work with within the committees. It also allowed Bob Glauber and Secretary Brady to come to the feeling that that was a prudential level. And these are things that, are not lost on us. We never deal with margins on stock indices today at the Board of Trade without thinking of those things. So we don't operate in the vacuum that we operated in before. Today, we have to be considerate of what each and every other exchange does, realizing that this is the most important theme that I think came from the Brady Report, is that this is one global market. Now, did we know that? We all really knew it, but did we act as though it was a global market? Really, we didn't. October 19th really shouldn't have been some big surprise. I mean, the stock market fell 260 points in 3 days, the close of the week before. On Sunday night, the Nikkei fell 620 points. The Hang Seng fell 420 points. The FTSE 100 fell 260 points. What could we have expected in this global environment and with the problems we had in the United States with trade deficits, with deficits, period? What could we have expected? It had to happen. I mean, the very fact that the stock market is back where it is today shows the confidence that the people have in this country. But it was as though when the market crashed, that market forces weren't at play. Like, God, how could this happen? The United States just crashed because the market crashed. Well, it wasn't the case. A market went down. A market had been going up. There was nothing wrong when the market was going up. It was only when it was going down. Evidenced by circuit breakers, by the way. Circuit breakers go in place when you go down, not when you go up. But the very fact that we could look at this and be so critical and find who caused this, who are these program traders, who's doing this index arbitrage, this portfolio insurance, should computers be able to be used in the markets? I mean, these were the questions asked at the time. And everyone wanted to point to someone else. And the problem when that happens is when someone points at you, you point back, and then you start fighting, and that's really just what happened at that point in time. Fortunately, from all of our perspectives, I think everyone feels that they were a victor of sorts. We were gratified because there was no legislation, and that was a major fight for us. There were calls for the jurisdiction over stock indices to go to the SEC. They're still with the CFTC. Even in the last reauthorization legislation for the CFTC, which was just completed, there's only Fed oversight of margins on stock indices. But we all have a new and heightened awareness. And I think that mistakes that were made in the past won't be made in the future. What about the media? The media fed it. The media didn't know anything about margins. They didn't understand performance bonds from credit margins. They didn't understand our system of having your pays and collection, your money paid before you start trading the next day as opposed to margins 5 days later. They didn't understand this. And we never thought we had the need to educate. Well, we found different. And hopefully, we have learned from our mistakes. Hopefully that we won't face this again in the future. But I do think the people that did the job did yeoman service. The Brady Commission coming into play and putting together a report that quickly, I think it was an amazing feat. I remember Nick Brady coming to the Board of Trade, meeting with us, going to our clearing corporation, walking out of the building and saying, this is very impressive. And then he went to meet with the banks and he got the daylight scared out of him because he realized how close things came to crashing down. And that's where he realized that there can be this type of gridlock and look to find a way that it would never happen again. Hopefully, the free market forces come into play. Hopefully, everyone does things voluntarily and has, and that we've got systems in place that it won't happen again. I thank you for tolerating me today, and I apologize again for being late. Thank you.
Again, if there are any questions specifically for Tom, why don't somebody ask it now? Otherwise, we'll do them all at the end. Okay. Our next speaker is Dick Grasso, who is, again, as I'm sure all you know, President and Chief Operating Officer of the New York Stock Exchange, and has been President on duty, certainly was on duty in 1987. Dick joined the New York Stock Exchange in 1968 and moved up through a series of senior positions to become president in 1988. He's the first member of the New York Stock Exchange staff to have been elected president. This, of course, happened because he is a graduate of the Advanced Management Program at the Harvard Business School. Richard?
Thank you very much, Bob. Good morning. The one most critical thing I learned in my experience at AMP was to never disagree with Bob Glauber. So I'm just going to shed some illumination that might contribute to your theory as to what indeed produced the experience of October of 1987. My congratulations. I want to join in all of the panelists here today in congratulating you and Dick Cavanaugh on bringing together the audience and the participants in what is clearly a unique symposium on the subject that continues, I think, to be as well researched today as it was when Bob and the team who created the Brady study and Rick and the team who created the SEC study and so many of the other participants who are here today created the various and important pieces of analysis that went into what did indeed happen in October of 1987, Bob. So congratulations to you and Dean Cavanaugh and to the Kennedy School. I'd like to take a little bit of a different tack from Tom and Duke and just reflect a bit on the events that built to the October experience, because I think there was some seeds sown in the earlier part of 1987 that clearly laid the groundwork for what we were going to experience in that period, the 14th through the 23rd. I will then touch upon how we, the New York Stock Exchange, dealt with the problems, clearly perhaps the most challenging period in market maintenance in the history of our 200-year-old institution, and then touch briefly on the post-break initiatives that we've put in place, some unilaterally and some in partnership with the markets that are represented here today. The experience of October of '87 actually began to unfold if one looks back to January of '87. We opened that year at just a tick under 1900 on the Dow, 1898 to be exact. The year opened with 12 consecutive up days, culminating into that point the most active day in the exchange's history, the first time we had ever crossed the 300 million share single-day volume level. That gave us a signal that the traditional relationships of average daily volume to peak utilization, that some of the strategies that were beginning to be utilized on a much broader basis were going to create a market that perhaps was outside of the model that we, from an operating standpoint, had developed for the years '87, '88, and the first part of 1989. And in fact, just shortly after that 300 million share day experience in January of '87, we made a decision that we would accelerate all of our technology investments that were due to be put into place over the course of the ensuing 30 months into 1987 and perhaps into the first half of 1987. Of course, the market continued to move, peaking from that opening point of 1898, peaking at 27.22 in August. And of course, if you look at that experience, not just in the 1987 time frame, but in the context of the beginnings of the bull market of the 80s, so August of 1982, the market had risen from 798 on the Dow to over 2,700. Understanding the events that took place beginning on the 19th require, as both Tom and Duke began to touch upon, some real focus on the events of the prior week. Bob's theory of the mechanism being the message, I'd like to just broaden a bit and suggest that perhaps it was a confluence of both mechanism-driven and fundamentally driven market revaluations. Realize at that point on the week prior to the 19th, we received a surprisingly large trade deficit report, which shocked a lot of people in a lot of markets. We had a twice upward adjustment in the prime. The budget negotiations in Washington had reached gridlock. We had an impending, or at least the suggestion of a pending tax code change that would have been quite negative in terms of the markets, and particularly the funding of some takeover activity. We had silkworm missiles flying over the Persian Gulf. And indeed, between the 14th and the 16th, we experienced roughly a 10% correction on the Dow. Now, just to show you how much analytical skill I was able to acquire in my experience here, as I walked off the floor on Friday the 16th, and I think Duke touched on this, the 16th was a critical day in the sense that it was the first time in history the Dow had suffered a triple-digit decline. By 3:40 in the afternoon, the market was down on the Dow cash basis 140 points. It then rallied to close, if I can use that term, rally in this context, off 108 points. Now, in the cycle, August of '82 through August of '87, there had not been the traditional 10% correction that most bull cycles, if you look back to the turn of the century, do indeed find themselves subjected to. Many people, including yours truly, walked off the floor on Friday the 16th. Dow down 108 points, a 10-point correction between Wednesday and Friday, the most active day in our history. 338 million shares changed hands that day. Many people walked off the floor thinking, indeed, this was merely that 10% correction long overdue. And I would say that while the Nikkei and the Hang Seng had significant moves on the Sunday, Some felt that that was indeed simply a trailing movement to the Friday's activity. My analytical skills are such that I was with a market maker over the weekend and suggested to him that Monday might indeed be the most significant buying opportunity of our careers. How right I was. Actually, if you just illuminate with one more fundamental, call it fundamental / technical, that I think kicked in what we were going to experience between the 19th and the 23rd. On the Monday, the long rate ticked above the traditional, and I think this, and there are plenty of academicians who will correct me on this, I think the measurement was the 51-year rate of return on common stocks, which then triggered some portfolio adjustments that needed to be made based on pragmatic approach. That all set the stage for what we were going to see. Realize in the 5.5 trading days between the 16th and the 23rd, the New York Stock Exchange handled the equivalent of 1967's volume, some 2.6 billion shares traded hands. Everyone remembers exactly where they were and what they were doing on the 19th. What lots of people forget is that the 20th was the day, I think, that we were most in peril, not just in the equity arena, but on an interlinked basis domestically and certainly from a global standpoint. Realize that between the 14th and midday on the 20th, $1 trillion was taken out of the marketplace, roughly 3 times the decline of October of 1929. In terms of systemic demand on the New York Stock Exchange, people like to point to the consecutive days, beginning with the Friday of 338 million shares, 604 million shares, our most active day, 608 million shares. But share volume is not truly the best barometer of just whether we're weathering a storm. We look at demand in terms of order populations. We look at demand in terms of sides to comparison, which is a velocity factor of how many participants are in the marketplace. And most importantly, we look at demand from the standpoint of message per second utilization of our plant. By any of those measures, the consecutive 600 million share days understate how radical an assault there was on the capacity of our institution. Let me just share with you, and I won't go into a lot of statistics, but prior to the 19th, the most active day in our history, from an order population point of view, we experienced 242,000 orders on Friday the 16th. On Monday, that jumped to 470,000 orders. On Tuesday, that jumped to 585,000 orders. And on Wednesday, a day that no one remembers because we traded a mere 450 or so million shares, the order population was 582,000. Simply stated, that is an attempt to put a size 8 foot in a size 7 shoe. It's going to be patently uncomfortable. And indeed, our performance was not perfect. But when you remember that our capacity had been built, all right, in a rolling 5-year plan to sustain by 1987 year end between 430 and 440 million shares, and then you overlay the fact that we experienced consecutive 600 million share days, but more importantly, from a demand point of view on our systems, universes of orders and message per second utilization that were off the charts right through the year 1990 in that 5-year model. I must say it was a time that clearly was unprecedented, clearly was a dark day for investors, both individual and institution, but in terms of the performance of the New York Stock Exchange, I think it was one of our defining moments, a shining moment. If you look back, those of you who continue to research the '87 experience, to the period 12/30 on the 20th of October, all right, and compare our performance to any market, domestically, internationally, at a time when, as both Duke and Tom have said, there were a lot of people suggesting, a lot of professionals suggesting that we ring the bell. Right? We were it at that point in time. I think the great untold story is that these markets, all of us, stayed open, sustained a level of activity that no one would have suggested we could handle, and we were able, as Tom said, with a little bit of friction, but with a lot of enthusiasm and a lot of partnering, to take from that experience and weave together an intermarket coordinated effort that I think has served this country very well. I know it certainly served investors very well. Coming off the experience, we focused our energies in three areas. Internally, clearly, we had work to do in our capacity and contingency planning. Externally, we had the issue of investor confidence. And in terms of the interlinkage, that recognition that no one market, particularly markets that have products that shadow one another, could affect important change without coordination, we did indeed go forward on a very coordinated basis that has resulted in, I think, some very important changes. Capacity-wise at the New York Stock Exchange, we took a network which had traditionally experienced a relationship of peak to average utilization of some 1.7 to 2.2 and decided that we would build plant that could handle 5 times what we expect to be our average daily volume. Now, one of the other things Bob taught me in my experience at AMP was when you look at a business and it has a utilization rate under 20%, it is time to either change management or cut capacity. Okay, we've done neither, and my children say thank goodness in the former case, because we look at ourselves as having the responsibility to smoothly handle 200 million shares on an average basis as we do today, and to equally smoothly handle a spike of 1 billion shares. And indeed, the embedded capacity at our exchange has been rebuilt to a level of some 1,088 million shares in a single day. And if you're interested, later on I can talk about how we get to that number, but I can tell you I know it's there because twice a year on a Saturday, it's usually a very bright, sunny Saturday afternoon, yours truly, Ming the Merciless, asks that 500 people arrive, and they have one challenge: blow up the system. And they try very hard. They very aggressively pursue it. And indeed, last well, I guess it's about now 3 weeks ago, we had a test on a Saturday. We proved that we could handle a capacity rating of 210 messages a second, which do translate to that 1,088 million shares. But just to have some fun, we let everyone report whatever level of trade they choose to. Of course, everyone loves to report blocks of 99,900,000 shares, which meant on that Saturday at least we traded some 17.5 billion shares. My only hope is that if ever we experience that level of activity, the market is up 508 points. Having gone beyond the infrastructure capacity, point of sale needed a rebuild after the experience in '87. Prior to that week, we had some 215 workstations handling approximately 460 stocks. Clearly, we were headed in the right direction, but we did not have a sufficient dispersion of electronic books to accommodate what the superstructure could handle. Simply stated, we had an engine that clearly could outperform the tires on the car. And so in the ensuing 12 months, we papered the floor. I hate to use that term, but I love to tell you, every one of our 2,075 companies today has an electronic workstation on that floor receiving the messages that are coming through that SuperDot network. Duke talked about the need, particularly in the futures and options market, to be prepared to settle next day. Of course, we settle 5 days, but at that point we compared in as late as just minutes prior to settlement. In the post-October period, we've collapsed comparison to, in effect, a next day, and much of that comparison is done same day or same night, so that we've taken the risk of completion out of the back end. And lastly, we looked again from an internal planning point of view at dependence on a single site. We were not pleased with the fact that all of our technology was run out of a single campus, and so just last year we completed a division of our back end to 2 sites, one in Brooklyn, one in Lower Manhattan, different power grids, and we have the ability now to fold from one to the other invisibly, or at least they tell me invisibly. We almost tested that last Friday, but I'm very confident based on our simulations that we can indeed do it. The second area that we had to deal with was the area of investor confidence, the public's perception of what happened. And indeed, we were very fortunate that the experience of market breaks in the big market break, of course, of 1929, which translated into a terrible depression and a sharp downturn in economic performance, did not happen in 1987, but there was clearly a perceptual issue that we had to deal with of the public's access to the marketplace, fairness. Duke called it the Public Investor Express bus. It's actually called the Individual Investor Express Delivery Service. What we've basically done is carve out capacity in our system so that an entering broker-dealer with a customer order of 2,000 shares or less who so identifies that as an individual investor gets an express lane delivery direct to point of sale. I can tell you, having gone through with many of you in the audience the postmortems in terms of systemic performance, that it was not clearly what the public perceived it to be, but perception is reality, and so we now have, in effect, a dedicated capacity to make certain under all market conditions that public investor orders under that 2,000 level are immediately introduced into the marketplace. And I think that that's a very important, from a public investor confidence point of view, a very important initiative. Dealing with the other side of our market in terms of how we better coordinate the equity market with the forward markets, we got together just briefly after the experience with the CBT and the CME and developed the so-called shock absorber, which is far short of the circuit breaker at 96 points approximately on the Dow, measured actually in terms of S&P handles at the 12 level. We created the so-called sidecar, where for a period of 5 minutes, program trades will be diverted into a blind file when the CME goes on limit. When they touch that 12-point limit for a 30-minute time frame and stay at limit, we take all program trading and deliver it to a blind file, which in effect allows for an accumulation. It is visible to no one, including our specialist. At the end of that 5-minute time frame, we lift the lid. If the imbalance accumulated can be accommodated by the marketplace, we continue to trade. If it cannot, we interrupt individual stocks. I think that evidenced not only an important interconnect fail-safe between the forward market and the cash market, but I think it also evidenced the fact that there was indeed good coordination and cooperation between the Chicago Commodities Exchanges and the New York Stock Exchange. Perhaps the most important initiative in terms of dealing with the so-called issue of hypervolatility was our Rule 80A. 80A, unlike volatility collars, unlike some of the suggestions people had in terms of shooting computers or in some way turning the market back to pencil and paper, what 80A simply did was convert the index arbitrage component, the index arbitrageur, from a consumer of market liquidity to a provider of market liquidity when the Dow crosses the 50-point line. Under 50 points, index arbitrage continues to do as it normally would function in the marketplace. At 50 or above, up or down, index arbitrage takes on that new burden of having to buy if indeed the market is up greater than 50 points on a minus tick, down greater than 50 points, sell on a plus tick, and that creates a stability factor that we think has been quite important. Lastly, in terms of internal to our market, we significantly upgraded capital requirements for dealers, taking the minimum position financial ability test up threefold and the minimum capital test up tenfold. Perhaps more important than what any one singular market did, I think, is the coordination amongst markets, the recognition of a partnership between the forward market and the cash market, the options markets, and I think that we've had, as a result of some very good coaching from Bob and of course Secretary Brady, we've put together an intermarket coordination group that now meets regularly, looks at common issues, looks at not only performance issues structurally, but looks at the regulatory issues, was important in trying to define and deal with the problemsome issue of intermarket front-running. We have, as Tom mentioned earlier, a very good interactive communication system that we can utilize instantaneously. Each market is on that linkage with participants from both the SEC and the CFTC. And that initiation and coordination has worked very well in terms of some of the events that have occurred since 1987, not only the break in '89, but we've had some trying moments in terms of the move by Iraq. We've had some trying moments in terms of the coup in the then Soviet Union. And I think in all of those cases, we've evidenced some very significant strides in how we coordinate amongst our markets. Looking back to sum it up, I think that it's fair to say no one can stand in the way of a $4 trillion market finding its own level based on investor evaluation and perception. What we've tried to do, learning from the experience in 1987, is deal with the speed at which the market finds that level. Realize that it's interesting, we all come together today and focus on October of 1987. Twice in the last 5 years, this country has experienced 500-point moves in the stock market. October of '87 continues to be rich in terms of the analysis and oversight and continuing interest of people. No one focuses on August of 1990 through October of 1990, when indeed the Dow corrected by some 600 points. I think what we've done effectively, to quote one of the great market gurus, former SEC Commissioner Joe Grunfest, we have re-engineered the car. We have added dual airbags, we've added anti-lock brakes. We can't guarantee there won't be a collision, but we can certainly assure people that survival rates will be far higher. I thank you very much for having me.
Next speaker is Rick Ketchum, who is on the panel this morning in his present capacity as Executive Vice President of the NASD, which he's been since 1991. But back in 1987, Rick was Director of the Division of Market Regulation at the SEC. We had many teachers on the task force because a lot of us didn't know all we should have known about how markets work when we started out. Very simply, Rick and his colleagues at the SEC were as good teachers as we could ever have had. The companion study done by the SEC, I think, will stand for a long time as one of the outstanding pieces of research done on how markets operate. Rick?
Thank you very much, Bob. And thank you as well for for pulling this group together. And beyond that, thank you for you and Secretary Brady for the study you produced. It's very seldom that a study outlives its decade. Yet I think the Brady study today continues to be the seminal piece on anatomy of a market or markets under pressure. And as that, it continues to be as relevant today in trying to understand the markets of the 90s as it was in 1988 in trying to understand the crash of 1987. It's a relief, I note, to no longer be in government and be able to say that word, crash. We worked on market break for many a year. We didn't seem to fool anybody, including ourselves. I'd like to, again, to try to avoid too much redundancy, step back a little from the events of October 1987 to look at the entire last half of the decade of the 1980s and to try to look a little bit more closely at the question of what have we done and how has it worked. It is a relief to be some 5 years past and to be able to eschew, as has been done consistently across this panel, some of the theological arguments that bedeviled us all in the 1980s. And indeed, I think it's a benefit to stay in that direction. I think what comes out of it all, though, is one simple fact, and that is that the second half of the 1980 decade was different. It was different not with respect to the volatility of the market as a whole on a day-to-day basis, but as Bob mentioned at the beginning, it was different with respect to spawning short and intense periods of extreme volatility. Whether that is looking at the fact that the substantial majority of 4% moves measured by any index during the last 50 years occurred during that half a decade, whether it is looking more statistically at the dramatic increase in kurtosis that occurred during that time period. One way or another, from middle 1980s on, something happened. Something happened with respect to the potential and opportunities for periods of extreme volatility. And that perhaps was the greatest challenge for regulators and the markets to respond to as they looked forward, both after reacting to 1987 and October 1989. And I think, again, the Brady study set forth very quickly, very accurately with its anatomy, what it was one had to look at. Because when one puts aside all the arguings and discussions on the Hill with regard to the activity and the interreaction and interrelation of markets, there are a couple of facts that come very clear. One of which was that no responsible authority during any of that time questioned that the changes that had occurred in the markets, as a result of portfolio theory and the development of derivative products, the development towards a marketplace that depended far larger on entities that were interested and desired to trade the market as a whole, who were interested in trading portfolios, trading programs, both because of the size of their positions and the desire for them to engage in asset allocation, that fundamentally that was a change that could not and should not be reversed, and that fundamentally the contribution of derivative products to both innovation and flexibility of institutional investors in the markets as a whole was a change that was desirable on a day-to-day basis, fed liquidity, and again not only should not be reversed but should be supported in the marketplace. So that with those basic assumptions that existed across the board, I think, among regulators and among markets at that time, notwithstanding the rhetoric that may have deceived one during that period of time, the question comes down to how, accepting those assumptions and accepting the importance of building from there, does one attempt to address the increased incidence of periods of extreme volatility. And I think there it's useful to take a look at what has been done and what are the exposures today. Because in effect, those incidents run at two questions. First, is there a means to soften those periods of activity? And secondly, recognizing to some degree that they will continue to be with us because we exist in a more institutionalized, more commoditized market today. How do we address the systemic risk concerns that result from that volatility? And again, the Brady study, I think, best set it out, that there are really three pieces that turns substantial market breaks into the panic selling that can move a market break into a market crash and threaten the fabric and indeed the systemic values and basis of the markets and the financial markets around the world. And those three pieces, I'd suggest, are first, the concerns or the potential for markets basing their activity on an illusion of liquidity, an illusion of short-term liquidity. Secondly, a fear during periods of market break of contraparty failure. And third, the simple concern that you can't get out of your positions. And I think on each of those points, highlighted in the Brady study, much has been done. But I think we're probably foolish if we simply celebrate and determine that, well, as Dick says, we've re-engineered the car, that the car is flawless or can't have a variety of things that still can be done to it. First, with respect to the efforts to soften periods of extreme volatility, I think there are 3 points of note, each of which are encouraging. First, and perhaps far more important than anything else, as was mentioned by Tom Donovan, has been the change in market perceptions, and Duke Chapman as well. Market perceptions have changed in two ways. First, they've changed with respect to professionals having a far better grasp of the degree of liquidity they can depend on short-term when a market is under pressure, and adjusting to market strategies which do not depend on aggressive selling during periods of time in which the markets are under pressure. Certainly that do not depend on them to the degree that they did in 1987. On the flip side, and equally encouraging, is that contrarians have come back into our marketplace. That a wide variety of market participants have recognized that there are buying opportunities in market breaks, not across the board and not without a great deal of feel for market timing, but nevertheless buying opportunities that once again engender the potential for different opinions when markets are under pressure. How does one build from I think, that critical free market adaptation to the realities of the 1980s? I think the steps that have been taken have generally done just that and have provided important support to the change in market perceptions. The first of those has been mentioned a number of times, been referred to as circuit breakers. I guess I'd like to talk about what I'd call shock absorbers, because I'd suggest we haven't tested circuit breakers to the extent that one's talking about trading halts in a marketplace today. We've pushed against it, but we haven't gotten there. Shock absorbers, on the other hand, have been used on a number of occasions, and I think very successfully, whether one's talking about futures price limits put in by the Merc and the Board of Trade, or talking about the New York Stock Exchange limitations on arbitrage activity, the sidecar and the 50-point limitations that Dick Grasso discussed. Well, everyone can analyze why the market feels more comfortable with shock absorbers, ranging from the economist's conclusion that placebos are nice things, to conclusions of persons who find a greater benefit. I think there are a couple things that are of value, that reflect the nature of markets when they're under pressure. What those shock absorbers do is continue to ensure the value of derivative markets, that they are there to provide people to take advantage of their enormous liquidity and speed and efficiency at most times, and yet recognize that in times when markets are under extreme pressure, there is a benefit to funneling much of the activity to a single place or to a single stock market, group of stock markets that provide a greater opportunity for the widest number of participants. And that in that time frame, emphasizing an environment where there can be a wide number of participants and where a small number of participants may have more difficulty in dominating that market is of value. And secondly, God forbid, there's a value at those times to some limited slowing down of the activity, some opportunity to allow people to more effectively gauge what's happening, to allow contrarians to be able to react after they've gauged what's happening in a time period in which they are not dominated or not essentially scared from that activity by the futures market where the number of participants are less. That's not gospel, and certainly recognize that there are many who would disagree with it, but from my standpoint, I find that a great comfort, and I think the markets as well do. The third point is now the availability and the authority that the Federal Reserve Board possesses with respect to setting margin standards on futures. No one, I think, who was serious or responsible involved during that time period had any difficulty distinguishing between margin requirements in stock and the fact that futures markets operated with performance bonds. But they also recognized that whatever one called it, margin involves leverage, and leverage has impacts in the marketplace and the people involved in that marketplace. Most importantly, with all the enormous advantages of the derivative approach to margin and the tremendous financial advantages of a mark-to-market system, low margins during periods of excessive volatility fundamentally results in a requirement that those markets increase those margins quickly and thus require payments from firms, payments from market participants, withdrawal, if you will, from liquidity at exactly the time when that liquidity is needed. That's not to say margins need to be same in the stock and in the futures market, much less the options market. Goodness knows they don't need to in any way at all. That's to say that some leavening of the shifts in margin levels in the derivative markets to avoid this potential for removal of liquidity and the contribution that gives towards when people are depending and looking to liquidity, not being able to find it in moments of pressure, is, from my standpoint, valuable and, again, an important step for market confidence. Well, that's the first piece. The second piece is the concern of not being able to get out and the potential for panic selling that exists from that concern. There, I'd suggest that all of the markets have done really extraordinary things. Dick has outlined what I think have been the enormous steps done by the New York Stock Exchange during that period. I'm very proud with my new hat of the steps taken by the NASDAQ market under Joe Hardiman's leadership, who you'll hear this afternoon, during that same time period. Because assuring not being able to, the concerns over not being able to get out is a multi-tiered effort. From the NASDAQ market, it required as well dramatic increases in capacity from a volume and being able to handle trades. It required, as we did, steps to ensure complete redundancy in our system, to ensure that the potential for a system failure simultaneously with either a large firm failure or a market pressure would not exist from a NASDAQ system. And finally, it ensured that that under intense pressure and enormous numbers of orders, that in a geographically dispersed market, there would be an assurance that you could get executions, whether you be a small investor or a large investor. I think we've achieved that in two ways. First, through the market maker obligations built into our small order execution system called SOES that both impose penalties for withdrawal of market makers that did not exist in 1987, and as well require commitment levels of effectively up to 5,000 shares for each market maker active in the security. A combined effort that ensures that when the public wants to get out in the NASDAQ market, when that market is under pressure, they'll be able to. At the same time, we've developed the SelectNet system, which again allows an avoidance for both market participants, dealers, or indirectly institutions to ensure that they can get through to another market maker without depending on the phone. And that system is, I think, provided, again, an assurance of execution that simply didn't exist in 1987. Well, the third piece is perhaps the most challenging, and that is the fear of contraparty risk. Nowhere, I think, has any study more graphically outlined the risks and concerns and impacts on the market of contraparty risk than the Brady study did. And the concerns both over the risk of failure of a clearing system as well as the failure of individual parties. That is by far the toughest thing to deal with, and I think we would be foolish to suggest that we have dealt with it, although a number of steps have been taken that I view as absolutely critical. First, and from my standpoint, perhaps the most important, has been the efforts of all the stock markets, both in particular, both the New York Stock Exchange and NASDAQ, to move to a same-day or next-day comparison of trades. The environment in 1987, when one simply didn't know what you'd done and whether or not the trades were going to settle, is an intolerable environment under high periods of volume and high periods of volatility, where positions are worth 20% more or less than they were before. The capability today, as a result of automation, both on the floors of exchanges and through NASDAQ and the ACT system, to ensure that generally on the same-day basis, trades are locked in, terms are agreed to, and that on the next day, market participants know what their positions are and have confidence that they're going to be able to trade out of them, trade from that position, is an absolutely critical step, and I think one of the least sung triumphs of the securities markets in the last 5 years. Other steps have been significant as well. Mentioned by Duke, there has been changes in capital requirements, both increasing requirements for market makers and addressing some of the risk-based issues from the clearing side that I think have been a substantial step forward. There has been improvements and enhancements of cross-margining that allow a recognition of more effectively of real risk and employing of cross-liens between futures and options exchanges that I think demonstrate enormous leadership by the CBOE and particularly the Chicago Merc that started it off on the futures side. Those steps, I think, all are terrific. They do not reflect an environment that does not have settlement risk today, and I think one of the challenges we have, both as markets regulators or you and firms today, is to expand our vision forward and to question existing means of settlement from the security side. We've addressed the clear comparison question. The question to address, I think, in the future is how we deal with settlement risk, both in addressing goals such as set out by the Group of 30 to continuously develop systems that allow us to shorten settlement periods, whether it be to move to T+3 or to reflect that our eventual goal long-term in the securities markets and the financial markets generally should be an online capability for us, both institutional investors and securities firms, that allows settlement to occur when comparison occurs, and to effectively ensure people to not only know what their position is, but to know that those positions have settled. And at the same time, to address the fact that we may never get to the call of the Brady Commission to have a single clearing entity or coordinated clearing system, but that we can get very close. And that the initial baby steps with regard to cross-liens and recognizing that we have many pools of security operating with our disparate clearing entities, to move to an increased sharing of information, increased use of cross-liens to ensure that whatever piece of the financial market is under pressure has access to security and access to assets of the market participants wherever they may be in the system. It's not an easy thing legally, it's not an easy thing from a turf standpoint, and it's not an easy thing from simply a practicality standpoint. But I think the steps to date from both communicating among security, stock, options, and futures market clearing entities and the beginning steps of cross-liens just suggest where we can go and where we can move even farther to reduce risk. I'd like to stop here again with appreciation for Bob. I think that one doesn't want to relive 1987 very often, but it is useful to look forward and try to think about where we should be in 1997, and hopefully it won't be in the same boat we were then. Thank you.
Our next panelist is Leo Melamed. I guess the right thing to say is that Leo invented much of what we're talking about. I think he clearly was a pioneer of financial futures and was responsible for the creation of the international money market, which was originally separate from and now is a part of the Chicago Mercantile Exchange. Leo is now chairman emeritus of the Merc. Back in 1987, he was chairman of the executive committee, and of course we dealt a great deal with them. He is now also chairman of Globex, which is the futures exchange's after-hours electronic trading system. Leo, good to have you here.
Well, thank you, Bob. Good morning. I want to join the chorus of congratulatory remarks to Bob for having put together this panel. Excuse me. I don't know how many people could have done it. But when he called me to do this, and I said, "What do you want?" He said, "Well, what went wrong?" And that was the topic assigned. I'm very literal in my assignments. And since I knew that there had already been 77, to my count, studies made of the crash, to add one more may be superfluous, but nevertheless, since that was my assignment, I literally did that. I will read some of it today. And it, I think, is the definitive answer of what went wrong, of course. But before I do that, with your indulgence, every one of us, as I was sitting here, every one of us experiences a moment in their life where they think back that they did something or were at an event in their life that critically changed the rest of their life. And we've all experienced that kind of moment. And we all think back, what would have been if I had turned right instead of going left, if I had not gone through that door, if I had not met that person or taken that plane ride, or what have you. And sitting there, I experienced that feeling again, not the first time. Because the first time, it occurred to me on October 19th, 1987. Hi, Ricky. When at 5 in the morning, my usual wake-up time, the radio came on, and someone was droning about how in London, the Dow was registering some 200 points below the previous close on Friday. That woke me up. Later, about an hour later, in the car on the way to the Chicago Merc, I got the call that half expected from John Phelan, who said, "Are you prepared for the day?" And I said, "No." "Are you?" He said, "No." I said, "That's good, we're even." And it was at that moment that I thought back to January of '87. Because in January of '87, I had gone to the board of directors of the Chicago Mercantile Exchange with a proposal. And the proposal was to institute what today we fondly call circuit breakers, but what Tom Donovan correctly said in our world were limits. S&Ps had no limits at the Merc. And I very much wanted limits. I was very concerned of what Dick Grasso described was the action of those days of that market, and concerned enough to suggest to our board that perhaps we should do what in many people's minds was the unthinkable: prevent the free market. Well, the long and short of it is that I worked it out with our board, called Susan Phillips, who was chairman of the CFTC, I'm Mary, then, and Susan said to me, "What, you, Leo?" And I said, "Well, yes, I think they're needed." And she said, "Well, if you suggest it, perhaps then we ought to go along as an experiment, but I want to warn you, if the commentary is negative in the users' minds, it'll never fly." When we tested it to the users, and I don't know how many users are in this audience, but I can tell you, there was only one, Lou Margolis of Salomon Brothers, who stood with me, but the attack was unbelievable. No one wanted to touch it. On October 19th, 1987, I thought about that. What world and how it would have been different had that been instituted. Maybe nothing would have happened different, but we'll never know. Here is the definitive answer of what went wrong. Bernard Baruch understood the sophisticated complexities of stock market movements about as well as anyone, and quoting an unnamed contemporary, the famous speculator explained the 1987 stock market crash in the following manner. Have you ever seen in some wood on a sunny, quiet day a cloud of flying gnats, thousands of them, hovering, apparently motionless, in a sunbeam? Yes? Well, did you ever see the whole flight, each mite apparently preserving its distance from all the others, suddenly move, say 3 feet to one side or the other? Well, what made them do that? A breeze? I said a quiet day. But try to recall. Did you ever see them move directly back again in the same unison? Well, what made them do that? That, in my humble opinion, says everything that needs to be said about the 1987 stock market crash. Indeed, I find it difficult to say it much better. But since my assignment might be a bit short if I were to end here, let me begin by just quoting another person who also thought he knew what caused it all, Alan Greenspan. In his report to the U.S. Federal Reserve Board, in his report to the Senate Banking Committee on February 2nd, 1988, he said the following: stock prices finally reached levels which stretched to incredulity expectations of rising real earnings and falling discount factors. Something had to snap. If it didn't happen in October, it would have happened soon thereafter. The immediate cause of the break was incidental. The market plunge was an accident waiting to happen. Indeed, he may be right, and it is important to hear what he has to say, since in my humble opinion, he was one of the most important elements in how we survived that crash and what he did after that crash. But he doesn't tell you what the immediate cause was. And I have one that I'd like to suggest, in all seriousness. Because high on my list of provocations, of an item potent enough to incite the psychological madness of that market collapse, was the following. As a consequence of our intolerable budget deficit, U.S. dependence on foreign capital creates a dangerously unstable environment for U.S. financial markets. Any perceived disruption of capital inflows into the dollar or U.S. bonds can act as the catalyst to cause sudden major value changes in equities. Such a very perception occurred in October of 1987 as a result of an open economic policy dispute between the U.S. Treasury and Germany's Bundesbank. Before you got there.
We had never opened it.
Right. I will not be the first nor the only one to suggest that the 1987 U.S. stock market crash was, in the words of economist David Hale, how global asset price distortions caused by the Louvre Accord were resolved. In other words, as Mr. Hale and others contend, by virtue of investor perceptions that the dollar would be stabilized and that there existed large valuation discrepancies in equity multiples between New York and Tokyo, foreign purchases of U.S. equities rose to the highest levels since the end of the 19th century, both in dollar terms and as a share of GNP. The same perception also caused waves of global equity diversification. Indeed, because of an explosion in global liquidity resulting primarily from central bank intervention to support the dollar at unrealistically high levels, share prices rose in most countries during 1987. This upward movement of U.S. share prices continued until investors began to sense that America's worsening trade, and that's been mentioned here, America's worsening trade deficit might force the dollar to decline. As David Hale concludes, it was no surprise that the market's worst days during October coincided with the publication of bad trade data and threats by Secretary James Baker to abandon the Louvre Accord. Those events caused domestic investors to fear that foreign institutions, especially Japanese ones, would dump the large equity portfolios which they had accumulated earlier in the year. It's interesting to note that when I approached Alan Greenspan, having given him the credit for saving the financial world, I think I could say this, that when I approached him subsequently and suggested, in my words, and I recorded them, that what the central bankers did, tinkering with the free market forces in a significant way, creates unnatural economic conditions that may beget unnatural economic consequences. Alan rejected the notion out of hand. Not the central bankers, he said. But even if the conditions were ripe for what Alan advises were incredulously high multiples, the intensity and severity that unfolded on October 19th was not predictable. Because on that day, we learned for the very first time the disparity between the market structures and what had happened to the ability to discharge decisions by market users. The previous 20 years had created a global economy with a technical competence that changed everything. Isaac Asimov once asserted that it was only with the coming of the Industrial Revolution that the rate of change became fast enough to be visible in a single lifetime. In a single lifetime? How about a single year? Or even a single day? Dr. Carver Mead of California Institute of Technology points out that the entire Industrial Revolution enhanced productivity by a factor of about 100. But the microelectronic revolution has already enhanced productivity in information-based technology by a factor of more than 1,000,000, and the end isn't even in sight yet. So, as it has throughout history, it was technology that changed the world. And indeed, if we think about it, the recent upheavals that we witnessed, the fall of communism, the emergence of the nations in Eastern Europe, the unification of Germany, the fall or beginning of the fall of apartheid, aren't they? Isn't the common denominator of their cause also the telecommunications revolution of the last 20 years, which gave everyone instant information about how their neighbors were living? And that same type of telecommunications capability caused what Walter Wriston called the information revolution. And that information revolution that connected the world with computers and telecommunication capability changed the world of finance like nothing before had done. And as a consequence, if conditions were right, as they were, on October 19th, the market suddenly discovered what Dick Grasso, the Chicago Mercantile Exchange, the Chicago Board of Trade, and Duke Chapman at the Options Exchange, that we just ain't ready for what kind of a deluge of orders could come upon us. And the car that Dick described then was exactly the car that we all had, one form or another. And it simply wasn't ready for what technology had done. We've done a lot better since. You've heard some of it today. You'll hear some of it in the panel later. And our car, I feel like a car salesman and keep talking about cars. But whatever the mechanism that we have provided is closer to the technological needs of today and tomorrow. But is it enough? Will it mean that the tulip mania of this century that we experienced in 1987 is the last one that mankind needs to worry about? Alas, I think not. For we suffer an inherent flaw. And author Charles Mackay explained that flaw in this fashion. Men, it has been said, think in herds. It will be seen that they go mad in herds, while they only recover their senses slowly, one by one. Thank you.
Okay. Our last panelist this morning is David Ruder, who, as all of you know, back in 1987, was chairman of the SEC and, as such, one of the frontline regulators on duty when this all struck. He held that position during the last 2 years of the Reagan administration. Prior to going to the SEC, he was dean of the Northwestern University Law School. And after he left Washington, he returned to Chicago. He rejoined the law school as a professor, as well as a law firm in Chicago. David, thank you.
The most overwhelming introduction that I had while I was chairman of the Securities and Exchange Commission was given the day that I spoke before the National Press Club, and the speaker introducing me noted that I had been born in 1929 and became chairman of the SEC in 1987, and suggested he would follow my career with interest. During the summer of 1987, when I was being considered for the post of the chairman of the Securities and Exchange Commission, I received an extensive briefing from the Securities and Exchange Commission staff. Part of that briefing included a briefing from the Division of Market Regulation, Rick Ketchum and Brandon Becker, who's here. And in that briefing, they told me about their concerns concerning market volatility. They described to me the events of September 11 and 12, 1986, in which the Dow had declined 120 points. They described to me the events of January 23, 1987, in which the intraday volatility in the markets could not be ascribed to economic matters. And they certainly captured my attention with that briefing. And from that day forward, I became quite concerned with matters of market volatility. In fact, the first public speech that I gave after becoming chairman was on October 6th, 1987, at the Bond Club in Chicago. And in that speech, I spoke about something I called the effect of derivative index markets on market volatility. And I described in that speech something that the staff had told me about, and that was something they called the John Phelan meltdown theory. And that theory, which John Phelan had been describing, talked about the possibilities of economic matters and the new futures and options markets joining together to cause a decline in our market of unexpected magnitude. The staff, as usual, was more gentle. They called it the cascade theory. I didn't care what it was called, but I was disturbed by it. And it was interesting to me that on the day of my speech, the Dow declined 90 points without any cause and effect, I might tell you. On Monday, the 19th of October, John Phelan called me to say, I guess the same thing he said to Leo, that pre-opening indications were that the market was going to suffer a substantial decline. I asked him to keep me advised, told my staff of his call, and I'm sure that there were calls from New York to the staff. Indeed, Rick was in New York, as I remember it, and I went off to give a speech at a conference sponsored by the American Stock Exchange on international securities markets. And I went into that speech at about 10 o'clock in the morning with the market having declined 100 points or so. And I can remember that I never gave a speech in which the audience seemed so uninterested. And there was this commotion, people running back and forth and giving notes to each other. And on the way out, I received a note. It said the market's down 200. And when I learned the amount of disarray in those markets, and learned that the briefing that I had received in the summer of 1987 had really been one which had portended the future, my life certainly changed in a way, I guess that one would say permanently, and I continue to be concerned about what happened and what will happen in the future. The week of October 19th, of course, carried a large number of difficult decisions for the Securities and Exchange Commission and the markets. Among other things, the SEC accepted the decision by the New York Stock Exchange to prevent use of the dot and super dot systems for program trading and index arbitrage transactions. We agreed to allow the New York Stock Exchange to shorten its trading hours. We monitored capital problems at the First Options Corporation in Chicago, knowing that if First Options went down 40% of the clearing and settlement capacity at CBOE would be going down, and that might have very negative effects for that exchange. We evaluated possible net capital problems stemming from major broker-dealer involvement in the British petroleum underwriting, and we're alert to the fact that 4 of our major brokerage firms might take substantial hits. Several specialist firms were unable to maintain their positions, and rumors flew throughout the markets that the one or another brokerage firm was failing. The rumor situation is best illustrated by the fact that our staff was calling every brokerage firm of any major capacity, and each brokerage firm, when asked about how well they were doing, said, "We're doing fine, but we hear that brokerage firm X is in real trouble." The rumors were flying, and and there were enormous difficulties stemming from them. We looked at technical market problems, substantial queuing of orders throughout the markets, the New York Stock Exchange unable to keep their price reporting system up to the market demand, clearing and settlements way behind and unknown, and generally speaking, a situation in which we were unable to find out whether orders were being executed and so at what prices. When stocks were open, there was tremendous gapping, price declines without continuity. But I agree with Dick Grasso that October 19th was not the most distressing day. October 20th was for me a moment in life that I hope never to experience again. On that day, the market had opened on a positive note and had risen approximately 200 points in the morning, and then at about noon had declined again to approximately its close on Monday, and there was no indication of where and when it might stop. And I received at that point a call from John Phelan telling me that buying support in the New York market had disappeared, that approximately 90 stocks that were part of the Standard & Poor's 500 index were not trading, that an additional number of stocks were not trading, and that he believed it might be necessary to close the exchange. He asked me whether I would give my support to that decision should it be necessary to make it. And I said, after conferring with my staff, that I would. John said that he would call the White House and tell them of his intent to close the exchange. My staff called the CFTC and various exchanges to alert them to the fact that the New York Exchange was probably going to close. About 10 minutes later, John called me back and said that while he was on the phone with the White House, the market had turned around and that the New York Stock Exchange was not going to close. To me, that instant in our markets was the most important event of the week of October 19th. For if the New York Stock Exchange had closed because of the inability of the market to function, one does not know what the economic consequences would have been for our country. And for that reason, my concentration regarding post-market events and indeed events of today is a concentration dealing not with intraday market volatility of small amounts or even large amounts, but concentration on the question of how to prevent a market meltdown, how to prevent a situation occurring in which our markets close because of events that we cannot control. After the crash, Kalo Heinemann, the then acting chairman of the CFTC, and I began to talk about what was important to do. And at our joint suggestion, we brought Leo Melamed and John Phelan to my office very early after the crash, a very small meeting with one aide only for each of us. And Kalo and I looked at them and said to them in the strongest terms that we could that it was the market participants, the exchanges, that had to bear the primary responsibility for fixing the markets. I'm not going to take credit for it, but I am entirely glad to hear of the words from each of the industry members here today and the exchange members of the way in which they are interacting and putting their joint resources together in a way in which the result may be that we can keep from having problems in the future. In fact, the events of the week of October 19th indicated clearly to me that one of the primary difficulties in the markets was the lack of communication between the derivative markets and the stock markets. These problems and lack of communication existed then and to some extent exist today because they lie, their source lies both in competitive matters and in policy differences. And with some trepidation, I raise again the question of what is the best regulatory system for our country. The stock market is a market representing real wealth. It is a long market in which shares traded on the U.S. stock exchanges represent the wealth of individuals and institutions. The derivative markets, on the other hand, are risk-shifting marketplaces. Since the sum of all positions in these markets is zeros, their regulators properly believe their function is to ensure that these markets function well. The motivations of the securities regulators are different. Securities regulators are charged with the duty of preserving the capital markets, as well as the duty of protecting investors. In one term, you might say that securities regulators are asked to guard against systemic risk. Indeed, this fundamental difference is one that has existed prior to the crash. Indeed, prior to the crash, I met with Calo Heinemann to talk about any differences that might exist between the CFTC and the SEC, and in the process of that discussion, I told him I was going to put on my academic hat, and I said, in my academic opinion, there should be one regulator, and that regulator ought to be the SEC. Calo didn't even smile at that suggestion. When the Brady Commission made its report, urging that there be a single market regulator or at least an agency entitled to make decisions when disputes existed between the two agencies, I was sympathetic with that recommendation. Indeed, I remember reading that report in the executive summary and reading right through it, and it said, and we believe that the proper regulator with the greatest experience and the greatest motivation to handle the problems of the two markets is the Federal Reserve Board. I said, what possibly motivated the Brady Commission to say that the Federal Reserve Board was the proper regulator of the commodities markets and the futures markets? And I must say, on that point, Alan Greenspan agreed with me that they didn't want anything to do with that regulatory system. It was clear to me that the market expertise and the desire to protect the capital markets made the Securities and Exchange Commission, and not the Federal Reserve Board or the CFT, the proper regulator of this single market that the Brady Commission had identified. This, of course, is not a simple conclusion. It carries with it enormous political overtones. As you know, jurisdiction over the securities markets and the commodities markets is in the hopeless jumble in Congress. The commodities markets don't want the SEC as their regulator, and certainly did demonstrate that fact by the 100 trips that Tom Donovan made to Washington in the 80s. In fact, I should have gotten an accommodation from United Airlines for having raised the question of this joint jurisdiction. I testified in that manner before the Congress when I made the report of the SEC, and I said that I believed it was important that the SEC regulate this joint market. And I want to add that the newspapers have it entirely wrong. This is not a turf battle. This is not a jurisdictional grab for power. It is an effort by a concerned regulatory agency to deal with the different policy points of view represented by the two markets. It's an effort by the regulator of the long market to try to deal with problems coming from a zero-sum market which may affect its market. Now, we did have a presidential commission, and we did come up with a great deal of a great many solutions which you've heard discussed here, many of which came from the Brady report, many of which came from the SEC study and its legislative proposals. And I am simply delighted that the Breeden Commission was able to bring the legislative program through Congress in a way in which my commission could not do. Now, although these improvements may help to protect the markets against future market volatility, I do not believe they should lead us to complacency. I wonder what the SEC staff will be telling the next SEC chairman in his briefings. To change the analogy which has already been discussed here, we have taken a road full of potholes, we have repaved it and resurfaced it and created a remarkably efficient method of transmitting demand from investors to that markets. And we need to deal with the question of what to do with that. My view, the approach thus far has not given nearly enough attention to the institutional investors in our market. Today, institutions own more than 50% of our equities. They account for between 70 or 80% of the trading on the New York Stock Exchange. The combined power of these institutions is so great that simultaneous decisions by these institutions and their money managers to sell in the market can cause the market to decline dramatically despite the existence of the safeguards now in place. Indeed, I think these institutions are the gnats that Leo was talking about. If they move in a great volume and for reasons that we can't comprehend in the same direction at the same time, there's nothing that our technical protections are going to be able to do. So I say I do not believe sufficient attention has been given to this institutional phenomenon, and I don't have a legislative or regulatory solution to offer you. I do have a hortatory solution to offer you, and that is to try to tell the institutions about this and to remind the institutions that their collective selling power, if exercised in a meaningless and mindless way, has the potential to drive our markets to a point that we did not reach in 1987, the point at which our markets would stop. It's my view that somehow or other the institutions have to be persuaded that there will be a point in the market decline in which they should not wait until the last bottom for the market before they enter the market, but they should be persuaded to enter the market to purchase in times of distressed selling. I know this seems irrational to institutions in one sense, but it certainly seems rational to me because these institutions, by behaving in that fashion, may have an opportunity to prevent the kind of calamity which did not occur in 1987. Thank you.
Needless to say, and not surprisingly, with 6 panelists, we're now running a little behind our schedule. But I still would like, if any of you have questions, to take a couple of questions before we adjourn for lunch, because we've all sat patiently. Steve, would you go to one of the microphones so that the videotape can record you?
It's a fine panel, and I congratulate all of you on the wonderful strides that have been made since that black day. Tom, I was in the Goldman Sachs trading room that day also. I heard very little said, however, about foreign and the foreign risk, counterparty risk. What if a major institution should go down in Europe? What happens if the Japanese stock exchange starts to melt down? And are we a little bit fighting the last war would be my question. I think only Mr. Melamed spoke at length about the foreign risk. Perhaps somebody might want to address that.
Not me.
I clearly agree with the sentiment that you are suggesting, that the foreign risk is one that we must be concerned with, because to a foreigner, they're concerned about us. We're the foreign risk to them, which only tells us one thing. We are living in a global economy. You know, somebody said to me the other day that, you know, you don't hear about globalization anymore. You used to hear about globalization. You don't hear about globalization anymore. Maybe there isn't such a thing as globalization. Well, the real reason is it happened already. I mean, this is it. You don't have to talk about it. We're living it. And so what you have is an interconnected planet where every piece of information is affected immediately and instantly to the market that's open. And I suggest that what we have to do is allow that kind of informational flow to let itself be felt in a way that evens itself out across border lines, rather than that which accumulates and waits for a market to open. That's one of our reasons for pushing on Globex, which is a way to keep our markets open on a 24-hour basis. And I know Mr. Donaldson is here, and I'm not going to tell the New York Stock Exchange what to do, but that's one of the concerns that we have, is that we would like to have our markets open as long as possible on a 24-hour basis to prevent the type of shock that might otherwise occur. And each market has to think about that. But I do agree that the foreign, so-called foreign investor problem is a very serious one, because we're no longer the only or the dominant factor in the world. Forget about it. What used to be is 60% of the world's stock result was what happened here. I think we're in the 20 percentile now of cause and effect on the world. And so that speaks for itself, Bob.
Very good. Dick?
Yeah, I just add that the problem is not limited to looking at international interconnectivity. There is an enormous amount of risk that is non-standardized onshore, and at last estimate probably between $3.5 and $5 trillion notional amount, whether it's currency swaps, interest rate swaps, synthetic securities portfolios, and none of the standardized markets, either marketplaces or the clearing organizations for those marketplaces, has the ability to oversee that, if you will, which I think is a far greater unknown and far greater systemic risk to our markets in this country. I think the interconnectivity of standardized markets, be they equities, options, futures, or hybrids, on a globalized basis has been well defined. I think that, you know, to Leo's point, we would love the opportunity to trade equities 24 hours a day. As soon as I can find someone who would like to trade General Motors at 3 a.m., rest assured, okay, our market is technologically prepared, and psychologically we'll kind of drag everyone with us to convene the facility. But I don't think at this point we see that level of demand to trade in the off hours are standardized products. Your point on risk is absolutely well taken. There is an enormity of risk that sits off the books, be they financial institutions or hybrids, in those three products that I talked about, that has yet to be factored in, and I think we're going to hear a little bit about that in the panel this afternoon.
Okay. Rick?
Dick really made the point I wanted to make. I'd only add that it is not an area that was forgotten, or at least with respect to action after 1987. I think one of the most significant long-term steps that was taken out of that was the legislation referred to as the Market Reform Act, and with that providing the SEC for the first time to be able to gain a glimpse from a financial standpoint of the activity in unregulated affiliates and international affiliates of U.S. broker-dealers. the need for that as a result of the developments in over-the-counter derivatives that Dick has mentioned, as well as the potential exposures overseas. Although when talking overseas, one has to recognize, talking about the organized markets, the level of position taking overseas is very different than the level of position taking in the U.S. But the non-standardized markets, and to return back to a point I tried to make earlier, the lack of any intermediated clearing facility, any spreading of that risk with respect to those non-standardized markets, as well as the exposure of market movements to those positions, I think is enormous. In fact, the SEC has some information on that I find encouraging, but I think it will be the regulatory and legislative challenge for the 1990s.
Okay, I've been told that we better go to lunch. Let me tell you the plan. Luncheon is in the building diagonally across the courtyard. There are people to direct you on the top floor in the penthouse. We have a luncheon speaker, only he is not going to be permitted to speak at lunch. Secretary Brady is going to speak, but he's going to speak back here in this room after lunch because all the television cameras are set up here. So we'll direct you over for lunch in the penthouse, and then when it looks like you've finished, we'll hustle you back here for Secretary Brady's speech.